Hey everyone, it's Mihai. Welcome to today's episode where we're uncovering the secret to building wealth investing for beginners. If you've ever dreamed of financial freedom, you know, the kind where you're calling the shots and living life on your own terms, but didn't know where to start, you're in the right place. Investing can seem intimidating, like this exclusive club reserved for Wall Street hotshots, but let me tell you, that's just not true. By understanding the basics, you can set yourself up for financial success. We're going to break down those barriers to entry, ditch the jargon, and get you comfortable with the idea of putting your money to work for you. Get ready to unlock the secrets of wealth building. So you're thinking about investing, huh? Good for you. But before we dive into the how, let's talk about the why. Why is investing so crucial, especially if you're just starting out? Well, let's face it, inflation is a real thing. It's like that annoying friend who always eats most of the pizza but never chips in. Except in this case, inflation eats away at the value of your hard-earned cash, year after year. See, if your money is just sitting in a savings account, earning minimal interest, it's actually losing purchasing power over time. Investing, on the other hand, gives your money the potential to grow at a rate that outpaces inflation, meaning you can actually buy more with your money in the future. And that, my friends, is what we call staying ahead of the game. But it's not just about keeping up with the rising cost of groceries. Investing is also the key to achieving your financial goals. Whether you're dreaming of owning a home, retiring early, traveling the world, or securing your children's education, investing can help make those dreams a reality. Think of it like this: every dollar you invest is like a little worker bee, earning you more money while you sleep. By putting your money to work, you're taking control of your financial future and setting yourself up for a brighter tomorrow. Alright, so you're ready to start investing, but where do you even begin? It can feel like stepping into a jungle of financial jargon, am I right? Don't worry, we're going to break down the key types of investments you need to know about, in plain English. First up, we've got stocks. Think of stocks like owning a tiny piece of a big company you believe in. When that company does well, the value of your stock goes up. And when they don't, well, you know the drill. Next, we've got bonds. Bonds are like IOUs, issued by governments or companies. They're generally considered less risky than stocks and can provide a steady stream of income. Then there are mutual funds. Imagine a basket of different stocks or bonds all grouped together. Mutual funds are a great way to diversify your investments, which we'll talk more about later. ETFs, or exchange-traded funds, are similar to mutual funds but are traded on stock exchanges, just like individual stocks. And of course, we can't forget about real estate. Now this one can be a bit more hands-on, but owning property can be a great way to build wealth over the long term. Remember, this is just a quick overview. We'll be diving deeper into each of these investment options in future videos, so be sure to subscribe and hit that notification bell so you don't miss out. Jumping into investing without a plan is like setting sail without a map. You might end up somewhere, but it probably won't be where you want to go. That's why, before you even think about buying your first stock or bond, you need a solid financial plan. Think of it as your roadmap to financial success. The first step is to take a good hard look at your current financial situation. Where are you at right now? What are your income and expenses? Do you have any debt you need to tackle? Once you have a clear picture of your finances, you can start setting some goals. What are you hoping to achieve through investing? Are you saving for retirement, a down payment on a house, your dream vacation, or all of the above? Be specific, set realistic timelines, and write those goals down. Trust me, having a clear target in mind will keep you motivated on your investing journey. Now, before you get caught up in the excitement of chasing returns, it's crucial to establish an emergency fund. This is your financial safety net, there to cover unexpected expenses like medical bills or car repairs without having to dip into your investments. Aim for 3 to 6 months worth of living expenses in a readily accessible account. With a solid financial plan in place, you'll be well on your way to making smart investment decisions and achieving your financial goals. Let's talk about risk, that often misunderstood aspect of investing. Here's the thing, every investment carries some level of risk. And understanding your own risk tolerance, how much volatility you're comfortable with, is absolutely crucial before you put your hard-earned money on the line. Think of it like this: are you the type of person who enjoys riding roller coasters, or do you prefer a more leisurely carousel ride? Your risk tolerance is kind of like that. Some people are comfortable with the ups and downs of the market, while others prefer a more conservative approach. And that's perfectly okay. There's no right or wrong answer when it comes to risk tolerance, it's a personal thing. Your risk tolerance is influenced by a bunch of factors like your age, your financial situation, your investment goals, and even your personality. Younger investors with a longer time horizon might be more comfortable taking on more risk, while those nearing retirement might prefer a more conservative approach to protect their nest egg. The key is to find the right balance for you. investing should be exciting, but it shouldn't keep you up at night. Determining your risk tolerance will help you build a portfolio that aligns with your comfort level, allowing you to weather market storms and stay the course. Remember, investing is a marathon, not a sprint, and understanding your risk tolerance is a key part of crossing that finish line. Let's talk about one of the most fundamental principles of investing: diversification. Now, you've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, diversification is basically that saying in action. It's all about spreading your investments across different asset classes, industries, and geographic locations. Think of it like this. If you invest all your money in a single company and that company goes belly up, well, you're out of luck. But if you diversify your portfolio, even if one investment takes a hit, the others can help cushion the blow. Diversification is your secret weapon against market volatility. It helps manage risk by ensuring that your entire portfolio isn't reliant on the performance of any single investment. A well-diversified portfolio is like a well-rounded breakfast. It's got a little bit of everything to keep you going strong. Now you might be thinking, diversification sounds great, but how do I actually do it? Well, one of the easiest ways is through index funds, or ETFs, which we talked about earlier. These investment vehicles offer built-in diversification by tracking a specific market index like the S&P 500. By investing in an S&P 500 index fund, for example, you're essentially buying a tiny piece of 500 different companies, spreading your risk across various industries. Remember, diversification is your friend. It's like having a financial safety net, allowing you to sleep soundly at night knowing that your investments are spread out and working hard for you. Here's the thing about investing, it's not just about the returns, it's about the net returns. What do I mean by that? Well, you need to factor in the often overlooked impact of fees. Those pesky little charges can seriously eat into your profits if you're not careful. We're talking about management fees, trading fees, expense ratios, the whole shebang. It's like going to a fancy restaurant, having a delicious meal, and then getting hit with a surprise service charge on the bill. Not cool, right? Now, I'm not saying all fees are bad. After all, financial professionals deserve to get paid for their services. But it's crucial to be aware of what you're paying and how those fees can impact your bottom line over time. Remember, even small percentages can add up to big bucks over the long run, thanks to the magic of compounding. So, how can you keep those fees in check? Well, one of the best things you can do is opt for low-cost investment options. Index funds and ETFs, in addition to being great for diversification, are known for their low expense ratios compared to actively managed funds. When comparing investment options, always pay close attention to the expense ratio, which represents the annual percentage of your investment that goes towards fees. Remember, knowledge is power. By being mindful of costs and fees, you'll be able to maximize your investment returns and keep more of your hard-earned money where it belongs, in your pocket. Alright, let's talk about everyone's favorite subject: taxes. Okay, maybe not everyone's favorite, but definitely important when it comes to investing. Did you know you can actually grow your wealth while minimizing your tax bill? It's true. And it's all thanks to the magic of tax-advantaged accounts. These accounts are like secret weapons in your financial arsenal, offering awesome tax benefits that can help you supercharge your savings. Now, the specific tax-advantaged accounts available to you will depend on your location and employment status. But here in the US, one of the most popular options is the 401k. This is an employer-sponsored retirement savings plan that allows you to contribute pre-tax dollars, meaning you don't pay taxes on that money until you withdraw it in retirement. It's like getting a discount on your taxes today while investing for your future self. Pretty sweet, right? And if your employer offers a 401k match, that's even better. It's like getting free money, people. Make sure you're contributing enough to get that full match. Another popular option is the Roth IRA, which offers tax-free withdrawals in retirement. With a Roth IRA, you contribute after-tax dollars, meaning you pay taxes up front, but then all your qualified withdrawals in retirement are completely tax-free. It's like having a golden ticket to tax-free income later in life. Taking advantage of tax-advantaged accounts is like giving your investments a turbo boost. By minimizing your tax liability, you keep more of your hard-earned money working for you, allowing your investments to grow even faster. There you have it, the basics of investing to get you started on your journey to financial freedom. Remember, investing doesn't have to be scary or complicated. By understanding the fundamentals, creating a solid plan, and staying consistent, you can build a brighter financial future for yourself. Don't forget to like and subscribe for more content on personal finance, real estate, and building wealth. Until next time, keep crushing it.